All right, so today we're diving deep into some financial fundamentals, specifically rates and returns. I know textbook excerpts don't exactly scream excitement, right?
Right.
But understanding this stuff is like unlocking cheat codes for your financial life, so I promise it's worth it. We're going to be focusing on chapter 1 from a financial textbook that you sent over.
Yeah, you're absolutely right. These concepts, they might seem a little bit dry at first,
A little bit.
but they are the foundation for making really smart decisions about your money.
That's exactly it. So let's just jump right in, shall we? The chapter kicks off by talking about interest rates, which on the surface, seem pretty simple.
Yeah.
Like it's what you pay to borrow money. Like if you take out a loan for a car or a house.
Well, that's definitely part of it, but interest rates are actually a much deeper concept.
Deeper. Okay.
Yeah, they tell us about something called the time value of money.
Okay, time value of money sounds kind of philosophical. What does that actually mean in practice?
Think of it this way. Would you rather have $100 today or $100 a year from now?
Today, of course.
hmm
I could buy like a really fancy coffee and a croissant right now.
Yeah,
A year from now, who knows what the price of croissants will be.
that's exactly the point. Money today is worth more than the same amount in the future. Because you can invest it, you can potentially earn more money with it.
Right.
And that potential for growth, that's what we mean by time value of money.
Okay, so where do interest rates actually fit into all of this?
Well, interest rates are essentially the price tag that we put on that time value.
Right.
They reflect the return that someone expects for letting you use their money for a period of time.
Oh. So it's not just about the cost of borrowing,
Yeah.
but also the potential earnings I'm missing out on by not investing that money. It's like an opportunity cost.
You got it. Now, some investments are considered practically risk-free.
Okay.
Like U.S. Treasury bonds, they offer a certain return with almost no chance of losing your initial investment.
Okay, but most investments come with some level of risk.
Right.
So that's where the idea of a required rate of return comes in, right?
Right.
Like it's got to be higher than the risk-free rate to make up for the chance that you could lose money.
Exactly, yeah. It's the minimum return that an investor wants to be compensated for the risk that they're taking.
Okay.
Think of it like this. If you could earn 2% with practically zero risk, you'd probably want at least, 5% or 6% to invest in something riskier.
Right. Makes sense. But how do we actually figure out that required rate? You can't just be like a random number pulled out of a hat.
It's definitely not random. It's calculated by adding different risk premiums on top of that risk-free rate. Think of them as extra insurance costs for different types of investment risks.
Okay, I'm intrigued. What kind of risks are we talking about here?
Well, first you have inflation, which is basically the rising cost of goods and services over time.
Okay.
That erodes the purchasing power of your money.
Okay.
So investors demand a premium to compensate for that.
So like how my grandma always complains that a loaf of bread used to cost a nickel.
Exactly. Then there's default risk. That's the chance that the borrower won't pay you back. Obviously, the riskier the borrower, the higher that premium will be. And then there's something called liquidity risk, which basically means some investments are harder to sell quickly.
Oh, okay.
So investors want a premium for that lack of flexibility. And finally, there's maturity risk, which means longer-term investments generally have higher premiums because there's more uncertainty over that longer time period.
Wow, okay. So there's a lot more to interest rates than meets the eye.
Exactly. It's not just one size fits all. It really depends on the specific investment and the level of risk.
It's a lot more nuanced. This is already making me think twice about some of my past investment choices, like yikes. Now, I see in our textbook excerpt, it also talks about calculating returns. And it looks like there's more than one way to actually do that. Why is that?
Great question. It's because different calculations tell us different things about an investment's performance over time. The textbook covers holding period return, arithmetic mean, geometric mean, and even something called harmonic mean.
Okay, whoa, hold on. I'm already feeling a bit lost in the terminology.
Ugh.
Can you walk us through these different approaches, maybe starting with something simple like that holding period return you mentioned?
Yeah, sure thing. Let's say you bought a stock, kind of on a whim.
We've all been there.
Yeah. You snag it for $50 a share, and a few months later you decide to sell it for $60. The holding period return, or HPR, simply tells you the percentage change in value over that period. So in this case, you made a $10 profit on a $50 investment, which is a 20% return.
Okay, so it's like a snapshot of how well that particular investment did over a specific time frame.
Yeah.
Simple enough. but I have a feeling it gets more complex than that.
You're right. HPR doesn't factor in the time value of money, which is where the different types of means come in.
Oh, okay.
Let's start with the arithmetic mean, which is just the most common type of average. You just add up all the returns and divide by the number of periods.
Okay, so if my investments had returns of 8%, 12%, and 4% over 3 years, I just add those up and divide by 3. That gives me an average return of 8%, right?
You got it.
Oh, wait.
But here's the catch. The arithmetic mean doesn't really tell the whole story,
Oh.
especially when we're dealing with investments. It ignores the magic of compounding, which is where the geometric mean comes in.
Ah, compounding. That's the snowball effect where
Yeah.
you earn returns on your returns, right?
Precisely. Imagine you invest $100 and you earn a 10% return the first year. So you now have $110.
Right.
The next year you earn another 10%. But now it's 10% of $110, not just your original $100.
Right.
That's the beauty of compounding. The geometric mean captures this effect, giving you a more accurate picture of that average compounded growth over time.
Okay, so it's like the arithmetic mean is sort of a simplified average, while the geometric mean takes into account that snowball effect of compounding. But when would I actually use one versus the other?
Well, the geometric mean is really essential when you're looking at long-term investment growth because it gives you a much more realistic idea of how your investments are compounding over time. And that can be super crucial for comparing different investment options.
Okay, so for quick calculations or a short time frame, the arithmetic mean might be fine, but for like long-term planning and comparisons, it's all about the geometric mean.
Yeah.
Got it. Now, what about that harmonic mean you mentioned earlier? Is that something I need to worry about?
The harmonic mean is a bit more specialized. It's mainly used for calculating the average cost of shares purchased over time,
Hi.
especially when you're buying different quantities at different prices,
Okay.
like when you're dollar cost averaging.
Dollar cost averaging. Isn't that when you invest a fixed amount of money at regular intervals,
Yeah.
regardless of the price, like setting up a recurring investment?
Exactly. And the harmonic mean helps you figure out your average cost per share in those scenarios.
Interesting. Okay. So we've got a handle on the different ways to measure returns, and it seems like choosing the right calculation really depends on what you're trying to analyze. But our journey through this financial textbook isn't over yet. There's one more concept that I always get tripped up on: the difference between money-weighted and time-weighted rates of return.
Oh, yeah.
Can you shed some light on that for me?
Sure, it's a common point of confusion. Money-weighted rate of return, or MWRR, is all about your personal investment decisions and their impact on your returns.
Okay.
It factors in the timing and the size of all your cash flows, deposits, withdrawals, dividends, the whole 9 yards.
So it's like a personalized report card that considers not just how the investments themselves perform, but also how my own decisions, affected the outcome.
Exactly. On the other hand, the time-weighted rate of return, or TWRR, tries to isolate the performance of the investments themselves.
Okay.
It removes the impact of your cash flows to give you a clearer picture of how well the underlying investments did, regardless of when you bought or sold.
Ah, okay. So if I'm constantly fiddling with my portfolio, adding money here, taking it out there, the MWRR will reflect that, while the TWRR will be more like judging the chef based solely on the quality of the dish, regardless of when the ingredients were added.
That's a great analogy. The TWRR is often used to evaluate the skill of an investment manager because it neutralizes the impact of the investor's decisions, which often the manager has no control over.
Right, that makes sense. So when would I use one versus the other? If I'm trying to judge my own overall portfolio performance, would I focus on the MWRR?
Exactly. But if you're trying to compare the performance of two different mutual funds, for example,
Right.
the TWRR might give you a more apples-to-apples comparison.
Okay, now let's get into the nitty-gritty of actually calculating these returns. Our textbook gives an example of calculating the money-weighted rate of return, and it involves finding something called the internal rate of return, or IRR.
Right.
Can you break that down for me?
Sure. The IRR is basically the discount rate that makes the present value of all your cash flows equal to 0.
Okay.
It takes into account all the money you put in, you take out of an investment, as well as any dividends or interest that you receive.
Okay.
The textbook uses an example of an investor buying a stock for $100 at the beginning of the year and then buying another share for $120 later on. By the end of the year, the stock is worth $130 per share. And the investor also received a $2 dividend per share.
Okay, so there's a lot going on there.
Yeah.
How do we actually calculate the IRR with all those moving parts?
It involves setting up an equation that considers all these cash flows,
Right.
the initial investments, the dividends, and that final sale price.
Okay.
And then solving for the discount rate that makes the equation balance out to zero.
Right.
This can be a bit tricky to do by hand, but luckily there are financial calculators and spreadsheet programs that can do it for you.
The textbook mentions using a financial calculator and has a professor's note about treating cash inflows as positive and cash outflows as negative. Can you demystify that for those of us who don't speak financial calculator?
Essentially, money coming into your pocket, like dividends,
Okay.
or the proceeds from selling an investment, are treated as positive values,
Go.
while money going out, like your initial investment,
All right.
is treated as negative. This helps the calculator or spreadsheet program figure out the IRR correctly.
Got it. So positive for money I'm happy about, negative for money I had to part with.
Exactly.
Okay, what about the time-weighted rate of return? How do we tackle that calculation?
For TWRR, you break down the investment period into subperiods based on when those cash flows happened.
Okay.
Then you calculate the HPR for each subperiod, and finally you chain those HPRs together using a fancy math formula to get the overall time-weighted return for the full period.
So it's a bit more involved than the MWRR, but it gives us that pure measure of the underlying investment performance, right?
Exactly. It helps us see how well those investments actually did, independent of the investor's timing or the amount of money involved.
This is so incredibly helpful. We've covered a lot of ground, from the basics of interest rates to the different ways of calculating returns, including the nuanced differences between money-weighted and time-weighted returns. I'm starting to feel like a financial whiz.
It's been quite a journey, but we're not done yet. There's still much more to explore in the world of rates and returns.
I can't wait. I'm feeling much more confident about navigating these financial waters now.
That's great to hear. We'll be back soon to continue our deep dive, exploring more fascinating aspects of this topic.
Welcome back. I'm still kind of buzzing from all that financial knowledge we unpacked in the first part of our deep dive into rates and returns.
Right.
Who knew interest rates and all those different ways of calculating returns could be so fascinating?
I told you it would be interesting. But we've really only just scratched the surface.
Okay.
There's so much more to uncover about how to interpret and actually apply these concepts in, real-world situations.
Well, I'm all ears. I am ready to level up my financial literacy even further. So what's next on the agenda?
Let's talk about annualized returns.
Okay.
They're a super handy way to standardize returns over different periods of time,
Okay.
which can be really helpful when you're, trying to compare different investment options.
Okay. Annualized returns. I vaguely remember hearing that term before, but refresh my memory. Why do we need to annualize returns anyway?
Well, think about it this way. Let's say you're comparing two investments. One earned a 6% return over 6 months,
Okay.
while the other earned a 10% return over a year.
Okay.
At first glance, the 10% return looks way better, right?
Yeah, it seemed like a no-brainer. Higher returns got to be better.
But hold on, they're over different time periods, so it's not really a fair comparison.
Right.
That's where annualized returns come in.
Okay.
They basically level the playing field by converting returns to an annual basis.
Right. Okay.
Making it easier to compare, apples to apples.
I see. So it's like converting different currencies to a common currency.
Exactly.
So you can accurately compare their values.
Okay.
How do we actually annualize a return, though? Is it a complicated calculation?
Not at all. The textbook provides a really simple formula, but let me just kind of illustrate it with an example.
Okay.
Let's say you invested in some hot new tech stock, and it returned a cool 8% but over just 3 months.
Okay.
To annualize that return, we first add 1 to the return. So that gives us 1.08.
Okay.
Since there are 4 3-month periods in a year, we raise 1.08 to the power of 4.
Okay.
This gives us approximately 1.36. Finally, we subtract 1, resulting in an annualized return of 0.36 or 36%.
Wow, 36%. That's significantly higher than that initial 8% return over 3 months.
Right.
Suddenly, that tech stock is looking even more appealing.
Exactly. Annualizing returns really helps us see the true potential of an investment over a full year, making it much easier to compare it with other investments that might have different time horizons.
That makes a lot of sense. It's like seeing the bigger picture rather than just focusing on like a short-term snapshot.
Yeah.
But remember how we talked about the time value of money earlier?
Right.
Does that concept play a role in annualized returns too?
Absolutely. In fact, the textbook delves even deeper into the time value of money.
Right.
specifically exploring the impact of compounding frequency
Okay.
on the present and future value of our investments.
Okay, compounding frequency. Remind me what that's all about again. It has something to do with how often interest is calculated, right?
You're right. It refers to how often the interest earned on an investment is added back to the principal, allowing it to, earn even more interest.
Right.
It can be compounded annually, semi-annually, quarterly, monthly, or even daily.
So the more frequently interest is compounded, the faster my investment grows. Like a snowball rolling downhill, picking up more and more snow as it goes.
That is a perfect analogy. And the textbook actually illustrates this beautifully with an example of how the present value of a future cash flow changes based on the compounding frequency, even if that stated annual interest rate stays the same.
Intriguing. Can you walk me through that example? I'm always up for seeing the power of compounding in action.
Okay, let's say you're expecting to receive $1,000 one year from now,
Okay.
maybe from a bond that matures.
Right.
If the annual interest rate is 5%, the present value, what that $1,000 is worth today, will depend on how often the interest is compounded.
So even though the interest rate is the same, the present value will kind of fluctuate depending on how often that interest is added back to the principal.
Precisely. If the interest is compounded annually, the present value of that $1,000 would be around $952. But if it's compounded semi-annually, the present value increases to $951.
Interesting. So even with the same interest rate, more frequent compounding means a slightly higher present value.
Yeah.
Does that difference become even more significant as the compounding frequency increases?
Absolutely. If the interest is compounded quarterly, the present value jumps to $951. And with monthly compounding, it edges even higher to $950.
Okay.
It might not seem like a huge difference, but over longer periods and with larger amounts, this can make a really significant impact.
Wow. So those seemingly small differences in compounding frequency can really add up over time. This is making me rethink my savings account, which probably only compounds interest monthly.
It's a great point. It's always worth considering how compounding frequency affects your investments. This brings us to a really fascinating concept called continuous compounding.
Continuous compounding. What is that? Does it mean my money is just like constantly growing every second of the day?
You're on the right track. It's a theoretical concept that imagines interest being compounded infinitely often,
Wow.
essentially nonstop.
Okay.
While not practically achievable in the real world, it's kind of a useful benchmark for understanding the power of compounding, taken to its extreme.
So it's like the ultimate compounding scenario, even if it's just theoretical.
Exactly. The textbook provides a formula for calculating this continuously compounded rate of return, but the key takeaway is that continuous compounding leads to the highest possible future value for a given investment, all else being equal.
Right.
It shows you the power of compounding in its kind of purest form.
This is blowing my mind. It's like unlocking like a secret level of financial growth.
It's definitely a powerful concept. Now let's shift gears a bit and talk about a few important distinctions that often trip people up.
Okay.
The difference between gross and net returns,
Okay.
as well as the difference between real and nominal returns.
Okay, let's break those down. What's the difference between gross and net returns? Do they both end up in my pocket?
Not quite. Gross return is simply the total return on an investment before deducting any fees or expenses.
Right.
Think of it like your salary before taxes.
Right.
Net return, on the other hand, is what's left after those fees are taken out. It's the actual amount you get to keep. It's like your take-home pay.
So net return is the real bottom line.
Yeah.
Fees can really eat into your returns, can't they?
Oh, absolutely.
It's like ordering takeout and getting hit with all those hidden delivery fees,
Exactly.
not so appetizing.
You got it. Always consider net returns when you're comparing different investments, because sometimes what looks like a high return on paper might not be so impressive once those fees are factored in.
Okay, that makes sense. Now, what about real and nominal returns? What's the difference there?
Nominal return is the return you see reported without considering the impact of inflation.
Okay.
It's like looking at a price tag without knowing if it's in dollars, euros, or yen.
Okay.
Real return, on the other hand, takes inflation into account. It's a measure of how much your purchasing power has actually increased.
So real return is like adjusting that price tag based on the currency exchange rate.
Perfect analogy.
It's the actual value I'm getting.
Right. Imagine an investment earned a 7% nominal return,
Okay.
but inflation was 3% during that same period. Your real return would only be around 4%. meaning your purchasing power only increased by 4%.
So inflation is like a silent thief,
Mm.
stealing away some of my hard-earned returns.
It can definitely be. It's really crucial to consider inflation when you're evaluating your investments and setting financial goals,
Right.
because a seemingly high nominal return might not be so impressive once inflation has taken its bite.
Okay, this has been an incredible eye-opener so far. I'm starting to see the world of rates and returns in a whole new light. It's not just about the numbers. It's about understanding the forces that are, shaping our financial well-being.
You're absolutely right. These concepts are the building blocks of making smart financial decisions.
So before we wrap up this part of our deep dives, can you remind me again, why does all this matter? How can understanding these concepts empower me or anyone listening to make better financial decisions?
It's all about gaining clarity and control over your finances. Understanding annualized returns allows you to compare investment opportunities on a level playing field, regardless of their time horizons. Knowing the ins and outs of compounding frequency helps you maximize that growth potential of your investments.
Right.
And grasping the difference between gross and net returns, as well as real and nominal returns, ensures that you're focusing on the metrics that truly matter, the ones that reflect your actual financial progress.
Well said. It's like having a financial GPS that guides me towards my goals.
Exactly. It kind of equips you with that knowledge to navigate those complexities of investing and make informed decisions that align with your financial aspirations.
I'm feeling so much more confident and empowered already. What's next on our journey of financial discovery?
Hold on tight. We're about to kind of explore the exciting and potentially risky world of leveraged returns.
Oh, okay.
It's a concept that can amplify both gains and losses.
Oh.
So buckle up for an exhilarating ride through the ups and downs of leverage.
Welcome back to our deep dive. We're on the final part of our exploration of rates and returns. We've covered a lot of ground, from the time value of money to the magic of compounding. But now it's time to tackle a concept that always makes me a little nervous. Leveraged returns.
Yeah, I understand why you might feel that way. Leverage can be a very powerful tool, but it's definitely not for the faint of heart.
Okay.
It's like adding rocket boosters to your investments. It can propel you forward with incredible speed, but it also, increases the risk of a crash landing.
Okay, that analogy paints a very vivid picture.
Yeah.
So what exactly is leverage and how does it work in the context of investments?
Okay, imagine you're at a carnival and you see a game where you can win a giant teddy bear.
Okay.
You only have a few dollars to play, but you're feeling lucky.
Right.
Then you spot a sign that says, double your chances to win, borrow money to play. That's essentially what leverage is, using borrowed money to increase your potential gains.
So in the investment world, I'm basically borrowing money to buy more stocks or other assets than I could with just my own cash.
Exactly. It's like taking out a loan to amplify your investment exposure.
Okay.
Let's say you have $1,000 to invest and you believe a particular stock is going to, skyrocket.
Right.
You could just invest your $1,000 and hope for the best. But if you're feeling really confident, maybe even a little bit daring, you could borrow another $1,000 and buy twice as many shares.
So I'm playing with $2,000, but only half of it's actually mine. Now, if that stock takes off, I'm making twice as much profit, right?
You got it. Let's say that stock goes up by 20%. If you had only invested your own $1,000, you'd make a $200 profit.
Right.
But because you leveraged your investment, you made a $400 profit.
Wow, that's quite a difference. Suddenly, leverage is sounding pretty tempting. But what happens if the stock doesn't actually go up? What if it goes down instead?
That's where the risk comes in. If that stock drops by 20%, you'd lose $400 instead of just $200.
Oh, okay.
Remember, leverage amplifies both gains and losses.
Okay, that's a very sobering thought. It's a very high-risk, high-reward scenario. It's like walking a tightrope. The view from the top is amazing, but one wrong step and you come crashing down.
That's a great way to put it. It's super important to understand those risks before you, start using leverage.
So how do we actually calculate leveraged returns? Is there a formula for that?
There is. The textbook provides a formula that takes into account your initial investment, the amount that you borrowed, and the return on the investment. It's basically a way to quantify the impact of leverage on your overall gains or losses.
So the higher the leverage, the greater the potential for both amazing success and epic failure.
Exactly. It's a delicate balancing act.
Yeah.
And it's super crucial to use leverage responsibly, only when you truly understand the risks involved and have a solid risk management plan in place.
Well, this has been an incredible journey through the world of rates and returns. I feel like we've covered so much ground, from the basics of interest rates to the intricacies of all those different return calculations, and then the power and peril of leverage.
It's been my pleasure to guide you through this financial landscape.
I feel much more financially savvy now, and I hope our listeners out there feel the same. So to wrap things up, I just want to say a huge thank you to you for breaking down these complex concepts in such a clear and understandable way.
You're very welcome. It's been fun.
And to all our listeners out there, remember, knowledge is power, especially when it comes to your personal finances. So keep learning, keep exploring. Until next time, happy investing.